In the spring of 1792, New York City was on the edge of something dangerous. The streets were loud, muddy, and tense, and outside a bleak stone jailhouse, a furious crowd had gathered. Rocks flew through the air. Voices screamed for blood. The mob wasn't demanding food or freedom from a tyrant. They wanted a banker. Locked inside that jail was one of the most powerful men in the young United States. Only weeks earlier, he had dined with elites, advised the federal government, and moved money as if it were air itself. Now he sat alone, stripped of his reputation and fortune, protected from the crowd, not by law, but by stone walls and fear. His name was William Dewar, and his collapse had detonated the first financial crisis in American history. The panic spread faster than anyone could stop it. Merchants lost their savings. Soldiers lost their pay. Widows lost what little security they had left after the Revolutionary War. The country was barely 3 years into life under its new constitution, and already the entire economic experiment seemed ready to implode. There was no central bank prepared to intervene, no regulator to pause trading, no formal stock exchange to stabilize prices. All that existed was rumor, leverage, and trust collapsing in real time. What followed was not just a crash, but a reckoning, because from the wreckage of that disaster, a small group of survivors would decide that chaos was no longer acceptable. 2 months later, beneath the branches of a tree on a quiet stretch of Wall Street, they would sign a private pact that permanently altered how money, power, and trust moved through the world. To understand how Wall Street was born, you have to begin with how close it came to dying. In 1792, New York was nothing like the financial capital we imagine today. It was a compact port town of roughly 30,000 people, crowded into the southern edge of Manhattan. Dirt roads cut between warehouses and taverns. Ships unloaded cargo directly onto the shoreline. The street known as Wall Street marked the former boundary of a defensive wall, not a center of global finance. There was no organized marketplace for securities. Buying and selling happened wherever people gathered on street corners, inside coffee houses, or beneath open awnings. Prices were shouted, not posted. Deals were sealed with handshakes. Reputation mattered more than contracts, because contracts were nearly impossible to enforce. The menu of investments was tiny. Traders dealt primarily in federal government debt, recently consolidated by Treasury Secretary Alexander Hamilton, and shares of a brand new institution, the First Bank of the United States. Hamilton believed that if the country wanted to survive, it needed credit. Bonds would bind the states together. A national bank would anchor commerce. But Hamilton had focused on creating financial instruments, not on building guardrails around them. The result was predictable. Speculation exploded. Ordinary citizens treated government bonds and bank shares like lottery tickets. Farmers borrowed against land. Shopkeepers sold inventory. Loans were issued at obscene interest rates. The belief was universal and absolute. Prices would only rise. William Dewar saw this madness and recognized opportunity. Dewar was perfectly positioned to exploit the moment. He had elite connections, insider access, and a reputation strong enough to make people trust him without question. More importantly, he understood leverage. He borrowed aggressively, issuing promises to pay that circulated like money themselves. He and his partners quietly bought up bank shares, using borrowed funds to force prices higher and higher. For a brief moment, it worked. Prices soared. Confidence fed on itself. Dewar became the center of the financial universe. Then the credit dried up. Banks realized the scale of Dewar's obligations and abruptly stopped lending. The federal government discovered missing funds and demanded answers. Rumors spread through coffeehouses and taverns with lethal speed. Once doubt entered the system, everything unraveled at once. People rushed to redeem Dewar's promises. He couldn't pay. The market froze. Prices collapsed. Trust vanished. By late March, the situation was so volatile that authorities jailed Dewar, not as punishment, but as protection. Outside, the crowd raged. Inside, the American economy teetered. The most damaging loss wasn't wealth, it was confidence. In a market built entirely on personal credibility, one man had proven that even the most trusted figures could be catastrophically insolvent. Trading ground to a halt. No one knew who was safe. Auctioneers exploited the panic, charging brutal fees and manipulating desperate sellers. The financial system Hamilton envisioned was imploding before it had a chance to mature. That's when a different kind of realization took hold. A group of brokers men who had survived the crash without gambling recklessly began to understand something fundamental. The problem wasn't just bad actors, it was structure. Or rather, the complete lack of it. They were tired of competing with auctioneers who took no risk and followed no rules. They were tired of being undercut by reckless speculators willing to work for nothing today in exchange for survival tomorrow. Most of all, they were tired of operating in a marketplace where trust could be destroyed overnight by a single failure. They didn't ask the government to intervene. They didn't wait for legislation. Instead, they chose a private solution. Over the following weeks, quiet conversations took place behind closed doors. Names were discussed. Reputations weighed. In the end, 24 men were selected brokers deemed solvent, reliable, and committed to long-term survival. They agreed to meet, not in a grand hall, but on the sidewalk outside 68 Wall Street, beneath a broad sycamore tree. On May 17, 1792, those 24 men gathered under its branches. They were rivals by nature, but necessity had changed the equation. If they continued fighting each other, the entire market would remain broken. Cooperation was no longer optional, it was survival. The document they signed that morning was shockingly short. Just 2 sentences. But within those sentences was a complete redesign of American finance. They agreed, first, that none of them would charge commissions below a fixed minimum. No more price wars. No more desperation trades. Every transaction would be profitable enough to sustain a legitimate business. Second, they agreed to trade with each other before anyone else. Business would circulate within the group. Outsiders, auctioneers, speculators, opportunists would be cut off from the best flow of deals. With that, the open chaos of the street market ended. The market was no longer a place. It was a club. That decision restored stability almost immediately. Prices calmed. Liquidity concentrated. Trust returned, not because the system became fair, but because it became controlled. The agreement didn't eliminate greed. It organized it. Within a year, the group moved indoors. Coffee houses replaced sidewalks. A trading culture emerged. Reputations became currency. Anyone who violated trust was expelled and ruined. Long before federal regulators existed, social exclusion enforced discipline. The Buttonwood Agreement didn't just create Wall Street. It defined what Wall Street would always be: a private network, managing public money, balancing order and exclusion, stability and power. And this was only the beginning. By the early 20th century, the world the Buttonwood brokers had created was almost unrecognizable from its origins under a tree. What began as a survival pact among 24 men had evolved into the most powerful financial institution on earth. The New York Stock Exchange no longer merely reflected the American economy. It dictated its rhythm. But beneath the marble columns and formal rules, the same foundational flaw remained. The exchange was still, at its core, a private club. Access was restricted. Information flowed unevenly. Power accumulated among insiders who believed they understood the system better than anyone else because they had built it. This belief would be tested brutally in 1907. The crisis didn't begin on the exchange floor. It began with a failed speculation, a familiar story echoing all the way back to William Duer. A group of financiers attempted to corner the stock of a copper company. When the scheme collapsed, it triggered a loss of confidence that rippled outward into the banking system. Trust companies, likely regulated institutions, holding millions in public deposits, came under immediate pressure. As depositors rushed to withdraw cash, banks hoarded money to protect themselves. That decision starved the stock exchange of liquidity. Brokers, dependent on short-term loans to finance trades, suddenly found themselves unable to meet obligations. By October, panic had arrived at the very heart of Wall Street. On a critical afternoon, the leadership of the exchange faced an unthinkable choice. Without cash to settle trades, they considered shutting down operations entirely. Closing early would have signaled total failure. Markets across the country would freeze. Businesses would collapse. The psychological damage alone could have lasted decades. Desperate, the exchange turned not to Washington, but to one man. J.P. Morgan was not an elected official, but in practice, he functioned as the central bank the United States did not yet have. When the president of the exchange arrived at Morgan's office and explained the situation, Morgan understood immediately what was at stake. Markets, he believed, ran on confidence. If the exchange closed, confidence would die. Morgan summoned the heads of New York's major banks and locked them in his private library. The doors remained shut until they agreed under immense pressure to pool tens of millions of dollars to keep the market functioning. Just minutes before the closing bell, the money reached the trading floor. The exchange survived, but the lesson was unmistakable. The entire American financial system had been saved, not by law, not by policy, but by an emergency meeting of powerful men behind closed doors. What worked in 1792 was no longer acceptable in a modern industrial nation. The Buttonwood model, private trust, enforced by social pressure, was reaching its limit. The warning went largely unheeded. In the years that followed, the exchange entered a period of extraordinary growth. New technologies, new industries, and a surge of public participation transformed the stock market into a national obsession. Price tickers carried market movements into cities and towns across the country. Ordinary citizens began investing in unprecedented numbers. But this democratization was superficial. Behind the scenes, manipulation flourished. Insider pools quietly coordinated price movements. Well-connected financiers accumulated shares in secret, drove prices higher, then sold to the public at the peak. These practices weren't hidden from the exchange. They were tolerated. Often, they were facilitated. The culture of the private club remained intact. By the late 1920s, optimism hardened into arrogance. Many on Wall Street believed they had mastered risk itself. Stock prices rose relentlessly. Credit expanded without restraint. Leverage became routine, not exceptional. The old belief returned in a new form. This time is different. It wasn't. When selling pressure finally overwhelmed the market in October 1929, the old playbook was used one last time. Leading financiers pooled money and attempted to stabilize prices through highly visible purchases. The gesture was meant to reassure the public, to project control. But the scale of the collapse was too large. Trust evaporated faster than capital could be deployed. The market fell, then fell again. Margin calls cascaded through the system. Banks failed. Businesses closed. Millions lost livelihoods, savings, and hope. The Great Depression was not just an economic disaster. It was a moral indictment. For the first time, the American public looked directly at Wall Street and demanded answers. Congressional investigators pulled back the curtain on the exchange's inner workings. What they revealed shocked the nation. Preferential treatment for politicians, systematic manipulation, and leaders who publicly defended stability while privately exploiting it. The myth of gentlemanly self-regulation collapsed. When one of the exchange's most respected figures was later exposed as an embezzler, the symbolic damage was irreversible. The handshake culture that began under the buttonwood tree was officially discredited. Washington responded decisively. New laws redefined the rules of finance. Disclosure became mandatory. Manipulation was criminalized. The Securities and Exchange Commission was created to enforce standards that private agreements never could. For the first time since 1792, Wall Street was no longer sovereign. The Buttonwood Agreement had not been repealed in name. But its spirit, private control, enforced by mutual trust, had been replaced by federal oversight. Yet the exchange did not disappear. It adapted through war, post-war expansion, and the rise of America as a global superpower. Wall Street remained the central artery of capital. It fought off competitors. It embraced technology selectively. Even as regulation increased, influence endured. But the world continued to change faster than institutions could. By the end of the 20th century, electronic trading undermined the dominance of physical floors. Algorithms replaced shouting brokers. Speed replaced relationships. The exchange itself transformed into a publicly traded corporation of final irony for an institution born as a private club. The tree was long gone. The coffee houses were gone. Even the floor was mostly ceremonial. But the legacy remained. The system created in response to a riot in 1792 still shaped how money moved. Who gained access, and who paid the price when trust failed. And that legacy would face its final judgment in the conclusion. If you walk down Wall Street today, past the barricades, cameras, and security guards, it's easy to forget how small this all began. Glass towers now stand where mud once pooled. Trillions of dollars move every day through invisible networks of fiber and code. Trades happen in microseconds, executed by machines that never sleep and never panic. Yet beneath all of it, the same question remains unanswered. Who controls trust? The Buttonwood Agreement was not a noble document. It wasn't written to protect the public or create fairness. It was written by frightened men trying to survive a system that had spun out of control. Their solution: restrict access, standardize profit, and trade only with insiders worked brilliantly. It stabilized the market. It attracted capital. It allowed the United States to grow from a fragile republic into an industrial power. But it also planted a permanent contradiction at the heart of American capitalism. The market became both a public necessity and a private privilege. For more than 2 centuries, Wall Street has lived inside that tension. Every boom and every crash is a replay of the same struggle that began in 1792. Openness versus control. Innovation versus stability. Democracy versus expertise. Each generation believes it has finally solved the problem. Each generation is proven wrong. Regulation replaced handshakes. Algorithms replaced brokers. Data centers replaced trading floors. But none of these changes eliminated the need for trust. They only changed how it is enforced and who gets to enforce it. When markets fail, they still fail for the same reason they did when William Doerr collapsed. Leverage grows faster than confidence, and belief outruns reality. When markets recover, they recover for the same reason the buttonwood brokers succeeded: coordination, exclusion, and the restoration of credibility, whether through private power or public law. Even today, the descendants of that agreement remain visible. Membership has been replaced by access to capital. Insider rooms have become information asymmetry. The tree is gone, but the shade remains. And perhaps that is the most uncomfortable truth. Modern finance did not evolve away from the buttonwood agreement. It scaled it. Every exchange, every clearinghouse, every closed trading system is a variation of the same idea. Markets do not function without boundaries. Someone decides who participates, how prices are formed, and what happens when things go wrong. The debate is not whether rules should exist. The debate is who writes them. In 1792, it was 24 brokers under a tree. In the 20th century, it was governments and central banks. In the 21st, it may be code, algorithms, or decentralized networks claiming to remove human control entirely. But even those systems are built by someone, governed by someone, and trusted by someone. A market without trust is a riot. A market with unchecked trust is a casino. Everything in between is compromise. The Buttonwood Agreement was both a triumph and a warning. It showed how quickly order can emerge from chaos and how easily that order can harden into privilege. It financed railroads, factories, wars, and revolutions. It also enabled crashes, manipulation, and inequality on a scale the original signers could never have imagined. The sycamore tree was cut down in the 19th century, but the system it inspired now spans the globe. From New York to London, from Tokyo to Singapore, markets operate on variations of the same foundation laid on a muddy sidewalk in Lower Manhattan. We are still living with the consequences of that morning. Every time markets freeze, every time bailouts are debated, every time insiders are accused of playing by different rules, the ghost of the Buttonwood Agreement returns. It asked the same question it asked in 1792. Is this market built for everyone, or only for those inside the circle? There is no final answer. There never has been. But understanding where Wall Street came from makes one thing clear. The system was not inevitable. It was chosen. And because it was chosen once, it can be questioned again. The tree is gone. The agreement remains. Hey everyone, if you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin. And don't forget to hit that bell icon so you never miss our latest videos.